One of the things we need to understand when we're putting together this model is we need to understand how a risk graph works. On the horizontal axis right here, we have the price of whatever we're looking at. And for us, we're going to look at just the market in general. We're just going to use like an S&P 500 ETF, for example. But this could be your portfolio value. This could be just the market in general. Okay, so we have a point here that is our cost. So let's say that we had $100,000 or $1 million or however much, and we went and just put it into the market today. We would have a cost that we have for that, and let's just label this arbitrarily $100. And if the price goes up, which is this way, or down this way, our profit or loss correspondingly changes over here on this graph. So this is our profit and loss. So if we own stock, basically it looks just like this. It's just a straight line up and down. If the price goes up, we have a profit. Okay? If the price goes down, we have a loss. Okay? Over here we have a profit. So there's nothing fancy at all about this. There's no curvature. There's no time value. There's nothing. If we buy an underlying, a stock in our case, or a portfolio of stocks, or a portfolio of ETFs, or a portfolio of mutual funds, we just have a straight forward risk graph. So the way we look at that is just a sloping line, just like that. Okay? Now, let's talk about a call option. A call option has the same upside as a, well, actually, let's draw the graph. A call option has the same upside as owning long stock, but we don't have any downside if we buy a call option. Okay, we pay $100 for a call option. If the stock goes way up, we make a lot of money, but if we lose and that call option expires, all we're out is our $100. That's one of the beauties of being long options. So, wow, that's terrible. So basically a call option looks like this. Okay, now remember over here is our P&L. So a call option is never free. So your graph is always going to look something like this, and our price where we buy the call option, the break even is always higher, and this represents our loss or our cost of our call option. Okay, so for example, if the stock price was at $100 when we bought this call option and we paid $5 for the call option, our break even is 105 at expiration, because if the stock price goes up to 105, our call will have $5 of intrinsic value. We paid $5. We can buy the stock at 100, so that's where we break even. Now the beauty of this is if the stock goes to 140, we make a lot of money up here. This is our profit. But if the stock goes down to 50, we're only out this $5 that we paid, because we don't have this part of the risk anymore. We've cut it off by limiting our risk of buying that call option. Okay? Now a put option is exactly the opposite. A put option looks like this. Okay, well, first, before we even talk about put options, let's talk about if we shorted a stock. If we shorted a stock, we get this type of graph, which is just the flip of long stock. So if this is our profit and loss, here's where we short it. If the stock price goes down, which is this way on our price graph, this is price, this is P&L, profit and loss. If the stock price moves down, we make money. Okay, that's the nature of being short. If the stock price goes up, we lose money because we're short the stock. We're wanting the stock to go down. A lot of times, being short stock is a foreign concept to people who've never done it before, but it's really easy. You just have to have the right margins set up in your account where you actually borrow the shares of stock before you buy it back later. So when you short stock, you're wanting the price to go down, and the profit graph is just the flip of being long. Okay, but now a put option, actually, it's kind of like the call. It makes money if the price goes down, but it has a finite amount where you're not losing money if the stock continues to go higher. Okay, so there's always a cost. So here's your break-even line is going to be here. If this is where we bought it, right here, then our break-even for the put is going to be lower than the price where we bought the put. So again, let's do our example. If the stock is trading at $100, we paid $5 for the put. Our break-even over here is going to be 95. So if we spend $5 buying a put, we get the right to sell that stock for $100. If the stock goes to 150, it expires worthless. All we're out is this $5 here. Okay, but if the stock goes to 50 and we have the right to sell it for 100 because we bought the put, here's the 50 down here. This is all profit. Okay, this is profit. So profit and loss graphs are very important, and we're going to use them a whole lot in talking about these models. So one of the things that that we can do is we can marry positions together or combine positions. So that's what we're going to do right now. So here's a long stock, and here is a put. What we're going to do is we're going to add these together. Okay, so if we have these values like this, if we go up here, our long stock is still positive. It's just reduced by this amount. Okay, so the whole time that this line here is horizontal, we've still got upside. But if we marry this, which is a big loss on being long our stock, to this, which is a profit of being long our put, what we get is flat on this side. Okay, so let me draw that again. So if we take a long stock and a long put and we add those together, what we get, this is the same as a long call. Okay, so here's a put, long put, and this is long stock. So owning stock and marrying a put to that gives you the same profit graph as a long call. So it's a very good question and a thought. What if we, instead of just owning stock, we just bought calls? We could do it with a lot less money. That's absolutely true, but call options and put options always have a time component, and that time component is why people trade options. Okay, the time component gives long calls a lot of leverage. You can create the exact same profit scenario with much less capital using call options than you can just owning stock. But you've always got a headwind. The price or the value of the long option, the value of the long option is always affected by time passing. If you are long options, you have a negative theta, which means you're losing time value. On the flip side to that, if you're a income investor and you're trying to make money from options, you want to sell options because that time premium is always working for you. So there are many strategies, and I teach these, how to structure trades to make money off the passage of time. Okay, so what we're going to do with this program is we're going to take your existing portfolio, which looks just like this, and we are going to learn how to hedge it, and we're going to make it turn into this. Okay, now this is what hedge funds do. Hedge funds figure out ways to make money if the market moves up and down, but for the most part, the reason people put their money in hedge funds is they don't want to lose a lot. They want to make a little bit less, or maybe they want to give up something to have protection so they don't have to worry about losing a huge amount of it. Okay, well, the way you do that is you take your mutual funds, your ETFs, your long retirement portfolio, and you buy puts, okay, to create this downside protection where you chop off that loss if the market price goes down. Well, traditionally, there's a big cost to that. Okay, if you're buying puts, that has a cost. Puts are insurance. So another way to think about this is if you had a house, you know, and you spent $400,000 cash on a house, and there wasn't a mortgage, there was nothing, you didn't owe anything on it, you just own the house, would you insure it against hail? Would you insure it against fire? Would you insure it against you know, a hurricane or trees crashing on it? Well, of course you would. Nobody in their right mind owns any kind of asset without thinking about insurance. If you have a Ferrari or a Jaguar, you know, that's worth $150,000, there's no way you're not going to have insurance. Can you tailor the insurance the way you want it? Absolutely. If you want to have a huge deductible and you say, okay, if I you know, if I have a car worth 150 grand, I don't want to insure it 100%, but I don't want to lose the full 150. How about if I total it, I get back 100? Okay, that would be a huge deductible, but your premiums would be less if you're insuring it for 100 than if you insured it for the full amount of 150. Same for your house. If you have a house, you can play with the deductible, and a lot of that depends on how much cash you have and how much you're willing how much of the risk you're willing to stomach yourself. So the insurance world is all about transferring risk. Well, it's the same thing with a portfolio. If you've got $1 million worth of stuff, funds, ETFs in your 401k plan, in your IRAs, in your accounts all together, how can you insure that? Well, you can figure out, okay, if the market drops by 20%, I only want to take a 3% loss. Well, you can do that with puts. The thing is, there's a cost. It's expensive, just like a house insurance premium or a car insurance premium. So you have to pay for that protection. Well, why doesn't everybody do that? Well, the reason is it's expensive. It's very expensive. If you want to fully insure a portfolio, you can do it, but it's going to cost you in the range of 1% per month. Okay, and that changes based on future projections. You know, it's just like if you were living on the coast and a hurricane is bearing down on you, if you called your insurance guy and said, hey, I want to insure my house and there's a hurricane on the way, it's going to be exorbitantly expensive. If you go on through 5 years with no hurricanes and you call them up and say, hey, I want to insure it, it's going to be much more reasonable. The insurance cost fluctuates based on what's going on in the world. Okay, same with the market. We measure that cost of insurance with a thing called volatility, and one of the instruments that tracks the volatility of the general market is the VIX. So when you hear them talking about the VIX, the VIX is a measure of how expensive these options are. And big money, hedge funds, huge institutions, they use options to hedge portfolios. When you go to the annuity company and you buy a guaranteed annuity, they're not just willy-nilly hoping that things work out. They've got their risk covered, and they do that in the options market. Okay, so here's a breakdown of what this program is going to be. We're going to create model portfolios to represent a long investment retirement type portfolio. If you have American funds, if you have Franklin Templeton funds, if you have ETFs, if you have you know, any kind of long portfolio, more than likely you're going to have a percentage of it in equities, okay, and you're going to have a percentage of it in fixed income instruments. I'm going to show you. We're going to go and play around with some websites, and we're going to put your portfolio into these websites, and it's going to spit out basically how much you have in equities, how much you have in fixed income. And it doesn't matter if it's international equities, large cap, small cap. I mean, you can drill this down into very fine detail. All I want to know is what percentage equities, what percentage fixed. If you end up with 65% equities, okay, and let's say you've got $1 million total, then we're going to work off that, and we're going to use 650,000 as our number that we want to hedge with puts. Okay, I'm creating model portfolios using two symbols. One is the S&P 500, which we're going to use SPY, and the other is Treasury bonds, which we're going to use TLT. This represents the fixed part, okay, and this represents the equity part. So I'm creating model portfolios with these two symbols, and then what we're going to do is we're going to use puts to hedge that. We are going to make sure that our downside if this is us right now, this is where we are, we want the upside to remain intact, as much of it as possible. We want this downside chopped off, and we want to flatten the downside where we have very little downside risk if we get a big correction. So basically what we're going to do is we're going to transform this normal long portfolio into one that looks sort of more like this. Okay, it's what hedge funds do. That's what I'm going to teach you to do with your own portfolio. That's why I've called this the poor man's hedge fund. If you've got $5 million, you don't need to learn this stuff. You just take your money to somewhere in New York or Buckhead or wherever and find the best of the brightest, and this is exactly what they do. If you want to do it yourself, that's why you need to join us on this channel, and I'm going to teach you how to do it. Okay. What we're going to do is we're going to buy puts to hedge it, but we're going to generate option income on the short term to help pay for the puts. So insurance is extremely important, but it's extremely expensive. If we can figure out a way to have the insurance but use other strategies to pay for it, that's what we're going to do. That's what I'm going to teach you. And if we're making money in the market, normally our hedges are going to lose money. That's the way it works. A hedge is in place to make money when something else loses money. So if the market goes down and we're losing money on our long portfolio, we want our hedges to make money so it offsets it and makes it flat over here. Okay? Typically, if you're hedging, that's a drag and it reduces your overall return. What we're going to try to do, and our models do a good job at this, is we're going to have our hedges in place to keep us from losing money on the downside, but we're going to use income strategies to pay for those hedges. And so if in a perfect world, if we can get this hedge to actually be costless and still have our upside, then we got our cake and eat it too. We make money if the market goes up, which is what we want, but we don't have to worry about losing a whole bunch of it if the market has a big downfall. So this is a very easy thing to Google. I just typed in S&P 500 total returns by year, and there's several of these websites, but this is one that I've referenced. So right now, 2022, we're down a little bit. We're off to not the greatest start in the world. Who knows what's going to happen this year? But looking back, the last 3 years have been extremely good. 31% in 2019, 18% in 2020, 28% in 2021. 2020, we had a big correction due to COVID. February and early March, we were down like 35% from the peak, but we ended up the year up 18. We got a very, very swift recovery from that. Before that, I just want to show you here, 2018, we were down a little bit, less than 5%. And then look at all these incredible years. We had 2015 was pretty much flat. 2011 was pretty much flat. Here's 2008. Okay, I was a retail advisor during 2008. It was brutal, being down 37%. Okay, there are lots of people right now who are trading that, I follow a lot of option groups and forums and things of that nature. If people are down, if the market dips 5%, people are like losing their whole savings because they're so levered up and they're trading in such a manner as to they don't understand how to manage risk. 2008, there were banks, there were mortgage companies, basically everything was going broke, going bankrupt. What's happened between 2008 and now? Well, if you go to the Fed's website, you can see the balance sheet is tremendous because the Fed has pumped so much money into the system. So, are we going to get that type of correction anytime soon? I have no idea when it's coming, but there's no doubt in my mind that everything is so linked together. We're going to have some very, very volatile and choppy markets ahead. So my goal, what I'm trying to do with my program and my Patreon channel, is to help educate people on how to use options to hedge their portfolio. Some people don't care. Some people aren't interested. Some people kind of trust the system that, if I leave it alone, it's going to dip, but it'll be fine. It'll come back. Well, that's okay if you're young enough and if your risk tolerance is such that you can kind of handle that. If you're you know, I'd say 50 or older. If you're maybe 55, if you're within 5 to 15 years of being ready to retire, we could have 2 or 3 years in a row where your wealth is significantly popped. And if you're already in retirement, well, here's the beauty of this. If you learn to hedge your portfolio properly, you can have it invested a lot differently than if you're just using your allocation to manage risk. In other words, if you've got, you know, if you're really worried about a big downturn, well, the way most advisors do it is, if I'm a very, very conservative investor, I might only put 20% in equities and the rest of it in fixed income. Well, right now, fixed income's paying nothing. So where do you get the income? Where do you get the return? How do you keep up with inflation? And we're starting to see inflation in return rear its head in a big way. So what if you could, instead of being 20-30% equities, what if you could be 80-90% equities? So you're making all that money when the market's doing well, like it has in the last 3 years, but you're hedged against the downside. Well, that's a better way to do it. You just got to learn how to hedge it. So this program is going to take some effort to learn about options, because you really do need to understand what you're doing. But once you kind of have an understanding, it honestly doesn't take that long. I mean, a couple hours a week at most. So you know, I'm offering this service with daily videos, and I'm going to share the model portfolios, and I'm going to share my daily adjustment of the hedges and how it works. And I hope people find value in it, and I hope I can help people. I decided long ago that I didn't want to manage money anymore. So don't email me and ask me to manage your money, because I'll tell you that I'm not interested in doing that. What I want to do is educate people. Nobody cares about your money as much as you do. So you need to learn how to do it. And stay tuned. I'll be sharing a lot more in the coming days and weeks. And see you next time. Thanks.